Markets are near all-time highs. The S&P 500, the Nasdaq, both pushing levels we have rarely seen before. On the surface, confidence is high. Momentum appears strong. The numbers look clean, but underneath those numbers, the conditions that have historically preceded the most unstable market periods in modern American history are forming right now. And the problem is, this setup rarely resolves slowly. The key shift driving this is not visible on any price chart, which means most participants are reacting to price, not the cause behind it. It is happening inside the system that controls the flow of every dollar through the entire U.S. economy. And once you understand what is changing, the market behavior you are seeing right now will make complete sense. Stay with me. The Federal Reserve controls interest rates. Interest rates control the cost of borrowing money. The cost of borrowing money controls how much liquidity flows through the economy. And liquidity, the available supply of money moving through markets, is the single most powerful driver of asset prices. Stocks, real estate, bonds, crypto, all of it responds to changes in liquidity. When the Fed lowers rates, borrowing becomes cheaper, money flows more freely, asset prices tend to rise. When the Fed raises rates, borrowing becomes more expensive. Liquidity tightens, asset prices tend to fall. This is the most fundamental mechanism in all of financial markets. And this is exactly why markets can look stable right before they are not. Because the person responsible for managing that mechanism just delivered his final public statement. And historically, this is exactly where mispricing begins. On April 29th, 2025, Jerome Powell delivered his farewell address as chairman of the Federal Reserve. He has held that position since 2018. In that speech, Powell stated, publicly, clearly, and on the record, that the Federal Reserve's operational independence is under threat. Not implied, not suggested, stated directly. Now, why does that matter to you specifically? Because the Federal Reserve is designed to make interest rate decisions based on economic data alone. Inflation readings, employment figures, GDP growth, consumer spending. It is not supposed to respond to political pressure. It is not supposed to adjust policy based on what a sitting president wants. That separation has been a foundational assumption of U.S. financial markets for decades, and that assumption is now being openly tested. And once that assumption changes, pricing changes with it. The pressure is not abstract, it is specific. It is documented, and its implications for your portfolio are already beginning to show up in the data. President Trump has publicly and repeatedly demanded that the Federal Reserve cut interest rates. He has made this position clear across press conferences, public statements, and direct social media posts. Jerome Powell declined to cut rates faster than economic data justified. Shortly after, Kevin Warsh was nominated by President Trump to become the next Federal Reserve Chairman. Warsh is a former Fed governor, a Wall Street veteran. Nominated by the sitting President of the United States, a president who has explicitly stated his preference for lower interest rates. Now, here is the mechanism you need to understand. If the new Fed chair moves to cut rates aggressively, borrowing becomes cheaper, liquidity expands, markets receive a short-term boost, prices rise across equities and risk assets. That is the part people celebrate. But here is the part that gets ignored. Lower rates, applied while inflation is still elevated, do not neutralize inflation, they accelerate it. Which means the market can rise while real conditions worsen. And that gap between what the market shows and what is actually happening underneath is exactly where the risk concentrates. This creates a conflict the market cannot ignore for long, and it sets the stage for the volatility pattern the data has shown clearly every single time this setup has appeared before. There is one more variable that makes this moment structurally different from previous transitions. The United States currently carries approximately $36 trillion in national debt. At current interest rates, the annual interest payment on that debt exceeds $1 trillion per year, more than the entire defense budget. Now, here is the trap this creates. If interest rates remain elevated, the cost of servicing that debt continues to grow. The government's fiscal position becomes increasingly strained. If interest rates are cut significantly, inflation pressure increases, which erodes the purchasing power of every American household. Both paths carry consequences. There is no neutral outcome. This is not a growth problem. It is a constraint problem. And the new Fed chair will be making critical decisions inside that constraint, beginning almost immediately. Now, before I tell you what this likely means for markets going forward, let me show you what the historical data actually says. Because this has happened before, multiple times, and the pattern does not repeat exactly, but it rhymes with enough precision to demand your full attention. I reviewed every Federal Reserve Chair transition in the modern era. In each case, I examined what happened to U.S. equity markets and risk assets in the weeks and months that followed. What the data shows is not a random distribution. It shows a consistent pattern of elevated volatility, and in most cases, significant price dislocations, during the period surrounding these transitions. Let me show you exactly what I mean. 1987, Volcker to Greenspan. Markets were near multi-year highs when the transition occurred. Sound familiar? 2 months later, October 19th, 1987, the S&P 500 declined 20.4% in a single trading session. It remains the largest single-day percentage decline in the index's recorded history. The transition did not directly cause that event, but it had disrupted market participants' understanding of how future monetary policy would be conducted, at exactly the moment when that understanding mattered most. The timing wasn't immediate, but the instability was. That's not the pattern. The pattern is what comes next. 2006. Greenspan to Bernanke. Ben Bernanke took the chair in February 2006. In the immediate period following, markets appeared stable. The S&P 500 moved approximately 1.2% in the first month. On the surface, the handoff looked orderly. And then 2008 arrived. The S&P 500 declined more than 56% from its peak, the worst economic contraction since the Great Depression. Which means stability after transition does not confirm safety. That's not the pattern. The pattern is what comes next. 2014, Bernanke to Yellen. Janet Yellen became the first woman to chair the Federal Reserve. In the 2 weeks immediately following her appointment, Bitcoin declined approximately 27%. Not 2 months, 2 weeks. 2018, Yellen to Powell. Jerome Powell takes the chair on February 5th, 2018. In the single month that followed, Bitcoin declined approximately 47%. The S&P 500 declined roughly 10% in 2 weeks, one of the sharpest short-term equity sell-offs of that entire market cycle. But here is the detail inside that period that most people completely miss. In the 3 weeks leading up to Yellen's departure, markets were being pushed higher, aggressively. Directional positions were being built at scale. Markets were taken to a short-term peak. And then, a rapid and significant reversal followed. This is where the behavior becomes repeatable. 2021. Powell renomination. On November 22nd, 2021, Powell was simply renominated for a second term. Not a new chair, not a dramatic policy announcement, just a renomination. Bitcoin declined approximately 53% from peak to trough in the months that followed. The S&P 500 declined roughly 25%. If a renomination produced that level of dislocation, the implications of a politically motivated full replacement deserve your serious consideration. Now, there is something specific happening in the current period that mirrors the pre-transition pattern from 2018, and it is worth examining directly. Kevin Warsh's nomination was formally announced on January 30th, 2025. From that date forward, Bitcoin declined approximately 30%, not from an arbitrary starting point. From the specific date, the next Fed chair was publicly identified. Meanwhile, the S&P 500 and NASDAQ moved toward all-time highs. This divergence between risk asset behavior and equity index performance is not unusual in these periods. It is actually a recognizable pattern. Equity indices, driven heavily by institutional flows, can remain elevated or even advance, while underlying risk sentiment deteriorates in more speculative markets first. Then, when the repositioning is complete, equities tend to follow, and the direction tends to correct faster than it was built. Markets rarely move in a single sustained direction during these transition periods. They shift just enough to reposition participants, and then they reverse. The people who recognize that repositioning while it is happening are the people who are not surprised by what comes next. So, what are the realistic outcomes from here? 3 scenarios are possible, and the third one is where the largest dislocations tend to occur. Scenario 1, liquidity expansion. The new Fed chair moves to reduce interest rates. Markets interpret this as expanded liquidity. Equities advance. Risk assets recover. Nominal portfolio values increase. This is the outcome markets are currently pricing with some degree of optimism. The risk embedded in this scenario, inflation does not retreat. It reaccelerates. And the purchasing power gains that nominal price increases appear to create are partially or fully offset by the rising cost of everything you buy. Your portfolio balance is larger. Your real wealth position may not be. Scenario 2, policy reversal. Inflation data deteriorates faster than expected. The Fed is forced to pause or reverse course on rate cuts. Liquidity tightens. Asset prices adjust downward. This scenario is less probable in the immediate near term, but it becomes increasingly likely the longer the first scenario persists without inflation responding. Scenario 3, rapid alternation. This is the scenario that requires your full attention. Markets initially move in one direction. Positioning concentrates on that directional assumption. Then, driven by new data, policy signals, or unexpected macro events, the direction shifts sharply. Participants who positioned on the initial move are now holding the wrong side. The adjustment happens faster than most can respond to. This is where the largest realized losses occur. It is also where the largest realized gains occur for those who anticipated it. And this is the environment where being early and being wrong look identical until they don't. And this is exactly where positioning errors become most costly. Because in high volatility conditions, the difference between a considered strategy and an emotional reaction is measured in significant real dollars. Let me be precise about what this analysis suggests. This is not a directional prediction. No one can state with certainty what markets will do in the next 60 days. What the data does show clearly is that the current period combines multiple factors that have historically produced elevated volatility. A Fed chair transition, markets near all-time highs during that transition, inflation above target, national debt at historically unprecedented levels, and a policy direction that is genuinely uncertain. Given that combination, the first question every investor should ask is not which direction the market will move. The first question is, if conditions become volatile, is my current positioning appropriate for that environment? Exposure levels determine sensitivity. In stable markets, this difference is small. In volatile markets, it becomes decisive. A portfolio highly concentrated in a single sector, asset class, or directional bet carries substantially more risk in a volatile environment than a diversified position with appropriate sizing. That is not a call to sell. It is not a call to buy. It is a call to examine your current positioning honestly, before conditions force that examination under pressure. The second question worth asking, am I tracking real returns or nominal returns? If your portfolio advances 10% while inflation runs at 6%, your nominal gain is 10%. Your real gain, in terms of what that money can actually purchase, is approximately 4%. In an environment where rate cuts may be accelerating while inflation remains elevated, the gap between nominal and real returns could widen significantly. Investors who are only watching their portfolio balance, not their purchasing power, may find themselves feeling wealthier while actually falling behind. Now, let me zoom out to the broader context, because what we are describing today is not just a Fed chair story, it is a structural story. The assumption that has anchored U.S. financial markets for decades, that monetary policy decisions are made on the basis of economic data, independent of political influence, is being openly questioned for the first time in a generation. This is not a partisan statement. It is a structural observation. Markets price stability. Markets price predictability. Markets price the assumption that certain institutional behaviors remain consistent. When those assumptions begin to shift, the repricing of that risk does not happen in a straight line, and this shift does not need to be confirmed to be priced. Markets begin adjusting the moment the probability distribution changes, even before any policy action is taken. There is also a global dimension worth understanding. The US dollar functions as the world's primary reserve currency. Foreign governments, sovereign wealth funds, central banks around the world hold trillions of dollars in dollar-denominated assets, specifically because they trust the institutional framework that backs those assets. If that institutional credibility weakens, if global investors begin to discount the Fed's commitment to price stability over political preference, the demand for dollar-denominated assets adjusts. A sustained decline in dollar demand means imported goods cost more, which means domestic inflation pressure increases further, which means the constraint we described earlier tightens. These are the second and third order effects that rarely make headlines until they are already fully in motion. The implications of this structural shift will become clearer in the coming weeks, particularly around the dates when the formal transition completes, and the first policy signals from the new chair begin to emerge. Markets will respond to those signals. The question is whether you understand the framework well enough to interpret that response accurately, or whether you are reacting to it without context. Here is what the data shows. Jerome Powell delivered his final speech as Fed chair on April 29, 2025. He stated directly that the Fed's independence is under political pressure. Kevin Warsh has been nominated by President Trump as the incoming chair. Every major Fed chair transition in the modern era has been accompanied by significantly elevated market volatility. In most cases, substantial price dislocations followed. In 2018, markets were pushed to short-term highs immediately before the transition, and then corrected sharply after. That same pattern is visible in current market structure right now. Bitcoin has already declined approximately 30% since the Warsh nomination was announced. The S&P 500 and NASDAQ remain near all-time highs. U.S. national debt stands near $36 trillion. Inflation remains above target. The structural constraint on monetary policy is real. 3 scenarios are possible: liquidity expansion, policy reversal, or rapid alternation. which is historically the most consequential for unprepared investors. Nominal gains may not reflect real purchasing power if inflation persists, and markets tend to move before clarity appears. In volatile conditions, strategy becomes more important than prediction. Understanding the mechanism matters more than guessing the direction, and positioning before conditions force your hand is almost always more effective than reacting after they already have. The data we covered today is not a forecast. It is a framework. Use it. Because markets will not wait for clarity. If this gave you a clearer picture of what is actually happening right now, drop one word in the comments: Warsh. It tells me this level of structural market analysis is exactly what you want more of. In the next video, linked right now, goes one layer deeper: how to actually construct a position, specifically designed for a high volatility transition environment. See you there.